Loud. Hi everybody, and as you heard in the very kind introduction, Strike is a ASX 300 listed net zero 2030 integrated gas, renewables and fertilizer developer. We're in the Perth Basin. We are taking our enormous natural gas endowment and we're taking that as far down the value chain as we can, through down to fertilizer, where we're accessing global gas pricing and a global gas market. But we've got here through the back of about 4 years of very hard work in the Perth Basin, where we've put together 7 consecutive successful exploration and appraisal wells that have made 4 gas discoveries. We've got 4 gas fields with contingent resources and reserves booked across that. We've taken FID on our first development at Walyering. We'll be in cash flows next year. We'll be looking to take FID on a $3.5 billion fertilizer plant at the end of next year. And as we move into the next couple of years from there, we'll be growing our cash flows in the domestic gas business. Strike is ultimately looking to be producing about 15% of WA's domestic gas by the end of 2025. And also by 2027, we'll be producing about $1.2 billion worth of fertilizer every year. So it's a pretty exciting journey that we've come from and one that we're going through. And I think what you can do is you can take the track record of success of high degree difficulty situations that my management team and the board of Strike have put together and been able to navigate, and look at our path forward. Yes, it is a complex one. It is one that is difficult, but it's a team that is showing exactly that they're capable of being able to make that transition. We are a business that effectively has built a strategy off a very large gas position in the Perth Basin. We're sitting on 3,500 square kilometres of prime acreage across 2 different plays, the Permian play in the north and the Jurassic play in the south. We have 4 gas discoveries between West Erregulla, South Erregulla, Ocean Hill and Walyering. We've got 1 that's in FID. We've got another one that's coming through, and in our gas resources and reserves at South Erregulla are on their way to unlocking the FID at Project Haber. It is a very integrated story, and that's because we are in a state that currently has an export ban for onshore gas in Western Australia. So there's a lot of method in the madness of going down the degree of difficulty for Project Haber, but I'll take you a little bit through that later on. And then last but not least, we've also acquired 100% of the geothermal rights over the existing geothermal rights over the Perth Basin. And that's because we can take our core skills of mapping subsurface environments and putting holes and stuff, and we can actually see a point in time in the latter part of this decade where we're using those skills to develop synchronous dispatchable renewable energy into the grid, where the state is looking to exit coal-fired power and ultimately decarbonise themselves towards their own net zero commitment. But really the core of the value of the company sits in an area we call Greater Erregulla, where Strike is operator across all of its own permits. We've had, as I said before, a really great run of success there, and you can see the well results between West Erregulla 2 to 5 and then South Erregulla 1, where we made 2 gas discoveries, where there is another gas discovery that will be flow tested in the next week or so in the Wodgina horizon. But this is a region that is showing that it is incredibly consistent, that that the net pay is consistent, that the results of the wells, the productivity of the wells are really, really good. This is gas that can compete with Qatar, Russia and America. This is gas that has a lifting cost of about 20 cents a gigajoule, and ultimately a full development cost of a bit over 50 cents a gigajoule. And that makes for a very interesting resource base to underpin value-added manufacturing here in Western Australia. When we look at the existing results of our wells and what we've currently got on the books, Strike is one of the largest reserve holders in the Perth Basin, and after we complete the independent certification of the South Erregulla gas discoveries and book our 2P and 2C resources there, I'm confident Strike is on track to be the largest reserve holder in the Perth Basin, which is a really exciting place to be, and it shows the results of the hard work that the company has put down over a period of really low activity in our industry. When 2020 and the headwinds of COVID came in, Strike lent into those. We put a rig on long-term contract. We continued to drill through the downturn, and we're coming back out into an environment where gas pricing is on the rise, where the access to undeveloped reserves is low, with a very large reserve base as a result of that decision to put that rig on a long-term contract and drill up a lot of our portfolio. But what you can also see is the upside in our resources. We have a 360 BCF of independently certified 2C resources at Ocean Hill, which has gone through a higher degree of certainty coming off the back of the success of the Walyering appraisal wells. And when we look at what that means in terms of the last major transaction that occurred in the basin, which was the acquisition of AWE by Mitsui in 2018, gas pricing was around $3.70. They paid $1.20 a gigajoule for in-ground 2P and 58 cents a gigajoule for 2P 2C. We translate that into a gas environment that we see today where the gas price is on the rise to about spot price close to about $6, term pricing closer to $8, and that means that in-ground gas is currently worth about $2 a gigajoule for reserves and about just under $1 for 2P 2C. Good news for us is we're headed towards cash flow, and I think one of the art of running a little small business like this over the 5.5 years that I've been the CEO at Strike is getting it to its maiden cash flows. And we're very fortunate that we have had a good amount of success at the Walyering gas field. Discovered in 1971, it's only taken 52 years for the appropriate amount of appraisal to occur here, where the success at Walyering 5, a well that flowed at 75 million standard cubic feet a day with 8 barrels of condensate per million standard cubic feet, followed up by Walyering 6, another 35 million standard cubic feet with around 10 barrels per million standard cubic feet of condensate. It's only $14 million to bring this guy online because it sits adjacent to the Parmelia gas pipeline where Wappet was successful in the 1971 with the Walyering 1 well, and they diverted the pipeline directly to it. So we're very fortunate. We don't have a big offshore field or a complex, deep, sour field that's requiring Strike to go on that difficult journey from developer or explorer to developer to producer. We have literally some wells that we can almost hook directly up to the pipeline. There is no impurities in this gas stream. It's incredibly cheap. It'll be one of the highest yielding, highest IRR gas projects developed in Australia of all time because gas pricing is so high and the cost of the development is so low. $14.4 million gross to bring it online. Strike 55% an operator, so $7.9 million our share. Wells already in the ground. It's a pretty exciting place to be at this point, at this juncture. And because we've had this success in our gas business, we're able to sort of look a bit beyond that. One of our core cultural focuses is how far into the future we are willing to look. We have gas fields that have 10 to 20 to almost 30 years of life to ultimately deplete those. Relying on gas markets, as you know them today, is a decision fraught with difficulty and monetisation options late in that period of time. By linking our energy to food through the manufacturing of fertilizers, we will institutionalise ourselves here in Australia, and particularly in Western Australia, as a key deliverer of a core commodity that ultimately underpins the population, and that is nitrogen-based fertilizer. Effectively, it's solid gas. 70% of the cost of a tonne of urea is linked to its natural gas. But why are we doing it? We're doing it for a few reasons. We're currently in a state where there is an export ban on onshore gas, and so we're using our integration into fertilizers to access a global gas-priced market. Urea is priced predominantly linked to its natural gas feedstock, and you can see the bar chart on the right-hand side, the difference between spot gas pricing, term gas pricing in Western Australia, and the 3.5 times uplift you will get if you turn your gas into urea. You'll get gas pricing that's equivalent to about $36 a gigajoule Australian. It's not quite the 60-something dollars you'd get in the spot market if you turned it into LNG, but it goes a long way. It also means that we don't have to deal with the cartel of buyers in Western Australia and also the cartel of suppliers. 85% of Western Australia's domestic gas is produced by 3 companies. 85% of WA's domestic gas is bought by 8 companies. If you are relying on 3 decades of gas to be monetised into a market of that size and shape, it is fraught with difficulty. You will always be a price taker, never a price maker. And by virtue of accessing urea markets, we are accessing a larger, more flexible market where we can link our natural resource endowment to international pricing. We can also use our carbon in the manufacturing of urea. We can take a TCF's worth of gas and put that carbon into a value add. It's not an offset, it's not an emission, it's not a cost, it's not a byproduct. It is actually a value add to our natural gas that ultimately leads to reaching that pricing outcome. And the last one, which is also something to point out, we will be building the largest hydrogen producing and consuming facility at Project Haber. It will produce and consume around 840,000 tonnes of ammonia, which is 140,000 tonnes per annum of hydrogen. That means that we are building a piece of infrastructure using our natural gas endowment today that can be decarbonised over the next coming decades as green hydrogen becomes more technically and commercially feasible. But we'll be making our hydrogen at 50 cents a kilogram, not at $8 a kilogram. So, we're in a really great place between now and then. Just a little bit about urea markets. Australia is an enormous urea consumer based on our sandy soils. Urea is the primary way of getting nitrogen into our soils. It's the lowest carbon, lowest cost way of putting nitrogen into crops in Australia. We're a big cropping nation. Over the last 12 months, between 2020 and 2021, urea consumption grew in Australia by about 20%. And that's because we got some good weather across the East Coast and the West Coast. In the last 12 months, I expect to see another similar 20% growth in urea consumption in Australia, because not only have we had another good year of weather, but we've also got the increase in grain and canola pricing that we've been seeing as a result of the impacts in Europe. Those impacts in Europe have actually had a 30% decrease in the seaborne availability of urea. And just like anything made of gas at the moment in the international space, urea pricing has gone through the roof because it is effectively solid gas. And finally, in a normal year, we would attack about 25% of the cost of a tonne of grain and about 54% of the carbon associated with a tonne of grain here in Western Australia, because we are domesticating supply chains, we're using great technology, and we're using low impurity adjacent natural gas in WA to make our urea. And we're doing it on a piece of land that we just acquired, 3,500 hectares of land in the Midwest. It's an area we now call the Low Carbon Manufacturing Precinct, because not only is it host to sitting over the top of 65% of the South Erregulla gas field discoveries and polygons, but it also it owns a piece of the ridge line, which is 30 kilometres inland, 300 metres elevated, and is host to most of Western Australia's top-performing renewable assets. It's actually some of Australia's top-performing renewable assets. So we've got the ability to take 70 megawatts of gas-fired power out of our urea plant and displace it with some of Australia's top-performing renewable energy, all in our own asset base. We're using the Midwest not just as a great place for gas and for subsurface results like in our geothermal, but we're also using the natural renewable endowment that land comes with. Here's a little layer cake you can see with the fertilizer plant sitting above that, the gas field sitting below, a sequestration reservoir that we've recently discovered and appraised as well. We're doing some work on the storage capacity there, and the wind farms sitting on top of that. But lastly, there is method in the madness. The West Australian government's last clue that they stuck out in front of everyone in August 2021 around navigating the export ban and getting an export exemption in Western Australia came from the downstream opportunity study. That study, which was produced by ASL Allen and then replied to by the West Australian government, effectively said those gas suppliers that support the creation of downstream manufacturing facilities in Western Australia should be able to access export capacity. And there is the clue. Fundamentally, if you think about the Northwest Shelf, it consumes about 3,000 terajoules a day of gas and employs around 114 people on the plant. Project Haber will consume 73 terajoules a day of gas and employ 300 people every day on that plant. These are job-creating pieces of infrastructure, and this is what the state government is trying to get us all to do. So with that, thanks very much.
I did not